Hello everybody, it's Yashar here, back again with another video. And in this video, I'm going to talk about RioCan Real Estate Investment Trust. I discuss their business, their future plans for 2022 and beyond, their dividend or distribution, the risk associated with this company, and finally, I will provide a detailed stock analysis using my personal discounted cash flow model using funds from operation or FFO for REITs, and will then provide you with a fair value of this REIT depending on your investment goals. The company HQ is located at Toronto and their shares are traded on TSX for almost 21 Canadian dollar at the time of recording this video. They pay a monthly dividend with a yield of almost 4.8% and the market capitalization of the company is around 6.8 billion Canadian dollar. Before starting the video, I want to emphasize that I'm not a financial advisor. This is not a financial advice for you to buy, hold, or sell this stock. This is just my personal opinion. You should always do your own research before making any financial decision. With that being said, let's start this video. RioCan is one of Canada's largest real estate investment trusts that owns, manages, and develops retail-focused and mixed-use properties. They own 204 properties, which worth around 15 billion Canadian dollar at the moment. The management in the last few years shifted the company's strategic direction by selling all US assets and part of the Canadian assets in the secondary markets, and instead focused on 6 major markets in Canada, mostly in prime locations in downtown areas of big cities in Canada like Toronto, Ottawa, Montreal, Calgary, Edmonton, and Vancouver, where we have dense populations and relatively high household incomes. 90% of their properties are retail, around 8% are office buildings, and only 2% are residential rental units, with almost 97% occupancy rate, which is not bad considering we just came out from a pandemic and lockdowns. RioCan owns some of the highest quality buildings in the best parts of the downtown areas of Toronto and Vancouver. For example, they are currently developing mixed-use commercial and residential buildings in core areas of Toronto with shopping centers, offices, and residential units on top, so you can work, shop, and live at the same place. RioCan believes 3 factors will contribute to increase the demand for their properties in the coming years: immigration and population increase in target cities, evolving retail experience, and lack of supply in these areas. By evolving retail experience, they mean large retailers like Walmart and Canadian Tire will need to expand their stores and bring hubs to proximity of their consumers in the next few years. Combine this fact with the surge in immigration and lack of supply, and all of this can drive the rent and prices of RioCan properties higher and higher, at least according to RioCan management. If we look at the numbers, we can see that RioCan was able to grow their funds from operation by over 10% in the last year, which is a good sign. But the problem is they had ups and downs in terms of the FFO growth in the past, and this is not a consistent growth rate for their funds from operation of the company. They even had years with negative FFO growth, which is definitely concerning. On the positive side, they were able to stabilize their occupancy and bring it back to pre-pandemic levels. They are also showing a growth of 3% year over year in the last 5 years in their rents, which can translate into further growth of their FFO in the coming years. For the future, they want to expand their business into residential units more aggressively by acquisition of multi-unit properties and continue to build mixed-use properties. Overall, the management anticipate to be able to return 10 to 12% year over year to shareholders via consistent dividend increases and capital appreciation via FFO growth in the coming years. RioCan cut and reduced its dividend during COVID-19 pandemic, which shareholders didn't like it at all. But they started to increase their dividend again this year, and hopefully we can see consistent dividend growth in the coming years with this REIT, as the management promised to keep paying a dividend yield between 4 to 5% with a conservative payout ratio of around 55% in the future. RioCan has a bad reputation between some investors after cutting the dividend during the pandemic, but I think it can overall help the company to pay down its debt faster and grow their business in the future. They are trying to use this excess capital they have after reducing the dividend to increase their net asset value by developing new properties in downtown areas of big Canadian cities, and consequently they can also increase their funds from operation. RioCan has almost 97% occupancy in their units, and they anticipate to be able to keep occupancy around 97 to 98% in the next 5 years. They have a little bit more debt than I like personally, as the debt to earnings before tax and deductions ratio is 9.5, which is not ideal, and they have planned to reduce this ratio to 8 or 9 in the next 5 years. The current dividend payout ratio is 57%, which is pretty safe in my opinion, and it is highly unlikely that the management want to cut the dividend again in the future. Overall, RioCan balance sheet is not the best balance sheet in the world, but I think their high quality properties gives investors a margin of safety. This is my favorite part of the video, where I can show you my stock analysis based on the financial data I discussed in the previous parts of the video. I use a discounted cash flow model, which basically estimates the values of a stock based on the projections for the future cash flows. So I make some assumptions about the growth of the company in the next 10 years and then discount the future cash flows into the present value of the stock based on my expected rate of return. So I start with the past 4-quarter funds from operation per share of the company, and based on 3 different scenarios, I predict the future FFO of the company in the next 10 years. In the bear case, or the most negative case for the stock, the company can grow 8% in the short term, and then the growth will drop to 6% in the long term. The 8% growth is coming from the growth in the business fund from operation and also their margins, their operating margins. I consider a terminal multiple of price to funds from operation to FFO of 10 for this case, which is consistent with historical bear periods for retail REITs. For normal case, I considered a little bit better growth and a terminal multiple of 13, which is historical average multiple for this company. For the bull case, or the best possible outcome, I consider the business can grow by 16% in the short term, and then it drops to 10% in the long term. And I consider terminal multiple of 16, which is bull multiple for this company. For growth stocks, I usually expect 15% return, and for dividend stable stocks, I expect 10% return. So, if I give 50% chance to normal case, 20% chance to the bear case, 25% to the bull case, and if I expect 10% return from this stock, the fair value of RioCan stock is 21.2 Canadian dollar, which means compared to current share price of 21.8, the shares are traded at almost 2% premium today, almost at its fair value, which is a buy according to the model. It means if you expect 10% return on your money, this stock is probably going to deliver that 10% year over year in the next 10 years. It's always fun to see what analyst predictions are for a company, and according to Yahoo Finance, the analyst price target for this company is currently at 26.3 Canadian dollar per share for 2022 with a buy rating. It is a buy according to research team, sector outperformer according to the Scotiabank analysts, and a hold according to the CFRA. Here I summarize the pros and cons of buying RioCan stock, which I discussed in detail in the previous parts of the video. Positive aspects of buying RioCan stock are their high quality assets with potential appreciation in their value in the future, a nice starting yield of almost 4.8% with monthly payouts, good occupancy rates of 97% for their units, and nice valuations close to its fair value based on discounted cash flow model. Now, the potential negative aspects of buying RioCan stock are relatively high debt to funds from operation of RioCan, 9.5 basically times ratio. The history of reducing the dividend during the pandemic, which disappoints some of the investors, and the fact that the stock is not great for rising interest rate environment due to the high debt of this company. So, there you are guys. I hope you enjoyed the video, and if you enjoyed the video, consider subscribing to the channel to see similar videos. Thank you for watching, and I see you in the next video. Farewell.